this price range that I'm looking forward to if we get this shift in market structure. Shift in market structure here on this candle here. At that moment, we have entered a buy program. So we have to go back into this range and anchor it to where we anticipate price going, that draw on liquidity. The initial one was here. So all of this run here, we could be sitting still, anticipating, not reacting, anticipating a run above that short-term high here. Why am I talking about this high? Low, lower low, lower low, okay? We consolidate. All through April and May, I'm outie. See ya. I want the market to show me something. I want to see it move out of this range, okay? Let's, just for a moment, let's ring in the bond market. During this consolidation in here, I want to see it perform a specific way. I want to see it show me something. All through here, I wanted to see the dollar go lower. I expected it to take out that low. But because it was showing an unwillingness to perform or show any willingness to go lower, how did I get to the point where I didn't trust it? Talk about how when we don't want to take a trade, when there's something in the price action that says don't do anything. Okay, let's do that right now. Here we have this low right there. See that little pierce below it right there? Little tiny little short move below that low right there. It can and it could have very easily traded back up to this level and then resumed. If it would have done that, then the dollar really would have been bearish longer term. But because it consolidated, I want to see, does it have confirmation through the bond market? To understand how the dollar is likely to perform, I use the bond market. But this consolidation in here, I want to see, does it perform in a mirror image of what the bond market is doing? The bond market was in a range, okay? And I wanted to see it go down into a discount. If the bond market goes down in a discount, that would result in the dollar index moving into a premium. Here's that range. Okay, we were in this range, and until this range was given up, until it left this range, dollar wasn't doing anything. Equities were going to range bound. That's why I stayed out. I want to see it leave this. This is market profile. Market profiles, to me, is a schematic. It's a behavior, a graph. I needed this range here to leave. I didn't care if it was going to go higher or lower because I didn't know at the time which one to trust. Because remember, on the daily dollar index, I wanted to see that low taken out. That's what I wanted. But I had to submit myself to what price was showing me. It was not willing to go there yet. So I had to take a step back and wait. Wait a minute, man. You're supposed to have 30 years experience. Right. That 30 years experience gave me the insights to say, sit still, bro. Wait. Let the elephant enter that swimming pool. Think about a children's swimming pool. Okay, a little tiny little swimming pool. If a swimming pool the size of a child would use, if you filled it up with water and an elephant came over and sat down in it, what would happen to the water? It would be displaced, right? It would leave the pool, being replaced with the mass of that elephant. Smart money is like that. In this range here, right here, when we saw it close right there outside that range, that sets the stage for up move in dollar. But I have to wait. I have to wait for something. This is Wednesday, May 17th. Let's go back over to the dollar index. All right, so here is May 17.3 there. Okay. Lo and behold, that's the day that the dollar index is trading inside of its fair value gap right there after post the shift in market structure. So this high broke to the upside. How can we qualify that as a shift in market structure for the dollar to keep going higher? I just taught you. Are we seeing a mirror image that would constitute a expectation for the bond market to enter a sell program? That means bonds going down, dollar going up. We're in a consolidation. We're in uncertainty here, so I have to wait. When this happened, okay, all focus goes to this fair value gap. But now I don't want to see it go up here to go short. Why? WAR, all those things, all that uncertainty, the debt ceiling, the potential default, all that stuff was a catalyst from a macro perspective, which is why I didn't believe that fair value gap would be a short. Now, if it would have went up here and started to sell off, like I said, I would use a lower time frame, 4-hour, 1 hour chart, short of a premium like that, and get in sync and then run for these lows here. But the context that I went into and I shared with you was I wanted to see that weekly fair value gap trade above it and come down and treat it as support. Look, this is the daily chart for the dollar index. Look where the bodies on the lower end of that gap, look where the bodies were. Was that not respecting that weekly gap? But you have to have your expectation calibrated to what the market profile is right now. That means we're in consolidation. I need to see what? I need to see bonds leave, because bonds will qualify whatever the dollar is going to do. I'm going to do a mirror image of it. So bonds broke lower. That means this is qualified as a break in market structure, and it's shifted higher. Fair value gap right there. Let's play devil's advocate and say for a moment, because this is a daily chart, and this is the dollar index, by the way. Let's say that you saw this happen after the fact. You were working, you were sleeping, you have a business you're running, just couldn't be in front of the charts, and you saw afterwards the day closes like this. The very next day, folks, the very next day, what do you think the bias should be for your analysis? Bullish. Reaching for what? That fair value gap. That run here to here, that right there is a sell program in euro. That means selling short. The dollar's going higher, so it's a short in euro dollar, short in pound dollar, short in Aussie dollar, short in New Zealand dollar, because the dollar going higher. Okay, it would be a long in dollar yen. It would be a long in dollar Swiss. Okay, because we're looking at, this is the dollar index. So if it's going higher, that range between here, by this day, it's after the fair value gap right here. Let me put it in the chart. Okay, so there's your fair value gap. So after that forms, the next day here, until it gets to your premium array, where's the draw on liquidity? Weekly order block. What's the multiplier? If you're a swing trader, it needs to find support here. So that sets the stage for your swing trade. But as a day trader, you don't need that. You're in there before that, which is why I don't do swing trades. I'm using the information I'm showing you here between this here, the idea of expecting higher prices on dollar index every day until it gets this objective first here. That sets the tone for a bias. That gives you your bias, because that bias is derived from the narrative that's being shown with higher time frame weekly and daily charts, also intermarket relationships, the bond market versus the dollar index, and market profiling. So we are in a consolidation. We have a shift in market structure. How do we qualify that? The range that I told you that bonds were in, the bonds are in a range. Until the bonds leave that range, all markets will be in consolidation, because interest rates are what makes the world go round. And then after that narrative is set, then we can have a bias. So the bias is bullish here for dollar, bullish here. It's even bullish on this day, but not in the scheme that we would expect it to open and then buy it and go up. We're in that range now, that fair value gap. So what we would expect is to consolidate or retrace, and does it support the low end of that range? And look at the body showing you that. That's a signature. That's algorithmic. So as a swing trader, you could use this day here as an entry, and then pyramid in here for a run into that, using that implied dealing range. An implied dealing range is not a dealing range like this, where we have a real high and a real low. Those are actual. We're looking for a price run from this low up to this order block on the weekly chart. Until it does that, that's an implied dealing range. We don't know if it's going there, but that run here, that is a implied dealing range. It has not really manifest yet, but we're seeing with anticipation that that's where the draw on liquidity is. The initial one was here. So now let's go and add our fib right there from this low to that high, which is the weekly order block. What I'm showing you there is the range. Okay, it's an implied dealing range. If we have that, look at the levels I have here: 75, 50, which is equilibrium, and 25. And then here's the high. The high of the run, which is terminus, at the end of the run, if you're going to use this as your dealing, not dealing range, if your implied dealing range, it's where you think it's going to go, low to high. That's terminus. We have 25%, 50%, and 75% of the range. We require bonds to do one or the other, go up or go down, and leave that range I showed you on its daily chart. It broke lower. Not yet, but now we have a shift in market structure right there. On the bond market, we qualified it with it going lower. It left its range going lower. That's going to give momentum to the upside on longs. Not that that's driving price, but that's setting your mindset in motion for it. We're in a buy program for dollar. So right away, we can anticipate somewhere in here, in this area, there's going to be some kind of accumulation. We consolidate here, and then we run. What does that make that right there? That's a fair value gap, right? Yeah, it's a fair value gap. More specifically, it's a breakaway gap. What is it breaking away from? It's breaking away from this consolidation. It has a shift in market structure. So this is your gap to trade. This is the gap that you use to qualify as a breakaway gap, and then trust it's likely going to draw here, which is why I communicated to you. I said, we want to see this traded to, but I'm more interested in trading it up above it and coming back down and finding it as support, which makes it an inversion fair value gap. 50% equilibrium. Look where that fair value gap forms. Equilibrium. Ooh. What do you think's significant about that 50% level? And why didn't that gap fully close? It's a measuring gap. That fair value gap is a measuring gap. This low, this candle did not come to that candle's high. That means we can anticipate this price run here to be duplicated to the upside. Meaning, let's say we have this low is lower than that low and relatively equal to that one. We don't need this low here. We want to see the energetic price run. That's this one here. So where does that root price run begin? That low right there. So if we take that and measure it up to the high of that fair value gap, why that? Because that's the highest range. So you want to use that as your base point. Extend it from there. I'm taking that high of the fair value gap. Here's the low of the fair value gap. I've duplicated that. So we now are seeing a range that's projected to go above this gap, which is why I was saying I want to see it go through it and then treat this gap as support. This was the draw. Now, it does go through it. Here's the upper 25% of it. Okay. It comes back down, immediate rebalance, 1 day delay. Remember when I talked about immediate rebalance? It's that next day or the very next day after that. Then you'll see the price run. There it is. Goes into the weekly order block, trades up into the daily order block, and the weekly mean threshold order block. Trades all the way up into those levels. Each one of these targets, okay, you're looking for price to continuously reach for them. You don't want to think that, okay, this is my first objective, and then once it trades there, go try to find some other setup in another market. No, you want to stick with it. Does it continuously keep digging into that? And then it drops from there down to some random level, down close candle, inside the weekly order block, weekly fair value gap, which is now an inversion fair value gap. This is the treatment of it on the daily chart. It comes down, hits it. Look at the reaction there. Do you think you could have took shorts in Eurodollar on that right there in the last 1 to 3 days? Well, let's go over to Eurodollar. So here is the Eurodollar, and this is the daily chart, and this is the immediate rebalance right here on Euro, and this was the fair value gap. I mentioned that we would draw down into up here. We drew down into it, and then we rallied one more time into this up close candle right here. That's a bearish order block. So here's the fair value gap I told you we would gravitate down to. And let's go back over the last few days here. Here's your order block here on your daily chart. Let's drop into a 60-minute chart. In this high down to that low here, do you see anything that stands out? Well, what did I just teach you about dealing ranges? You break the dealing range down. If we were seeing the dollar trade down into that inversion fair value gap on the daily chart, the inversion fair value gap is based on its weekly chart. That is a discount for the dollar. We could likely see it rally. Dollar rallied. That means that we're likely to see Eurodollar sell off. How can we anticipate that? And where would it form? Here's your high down to that low right there. Where's equilibrium? 50%. Right here. In close proximity, what do you see as a PD array that would be at that level or higher for a premium? Remember, if we want to be short, the highest probability shorts are occurring in premium markets above equilibrium. Continuation pattern or continuation premium for selling short in a bear market that's been a bear market for a while, you can sell right at the 50 level. But specifically in a premium, we want to see it get into this range here to here is premium. In that range between this low and that high, where is the PD array that the first one exists at a premium in that range from this high down to that low? When we retraced higher, went into this area right here, it went to this fair value gap, which is a SIBI, sell side imbalance, buy side inefficiency. Dollar goes higher because it's on its inversion fair value gap. Eurodollar sells off. This area right in here also is running what? Buy stops. Retail traders see this run here and all this consolidation. They see that as a bull flag. The logic here is opposed to what a retail-minded trader would see. And it's taking liquidity into account. That means the market went lower, we traded here, and we started to move a little bit here. Nobody in their right mind, keyword, would have trailed their stop loss on shorts to that level right there. But on this move lower, I promise you, every time Dick and Harry out there that's trading Forex, because they're ultra scared, they don't want to get stopped out. They don't want to have their profits erode, and they trail their stop loss too tight. And you know what I'm talking about. You're nodding your head thinking, stop talking about me. There's liquidity above old highs and lows. That's 101 in terms of understanding where markets are going to reach for liquidity. So the algorithm will deliver price above this high to take into account for buy stops being brought to the marketplace. Those market orders are now buying at the market, which is what smart money will offer shorts to the marketplace at that same time. Where, in what price range? In this fair value gap. Where would be the opposing draw on price once it went into here? Right above this high here is the buy stop. So it trades there, which is the opposite of what we saw dollar doing. At this moment right here, dollar index, right at 2 a.m. on Tuesday, June 6th, okay, 2 a.m., the dollar index was making that low here on the fair value gap. See that? So it's a mirror image. So you're qualifying setups, not just on the basis of you see it in your chart you're trading. You have to use some intermarket relationships that would say the opposite. For instance, if we're trying to go short on euro, you want to see something that would constitute a long in dollar. If you can't really see it in dollar, that's opposed to your cable trade, which is pound dollar, or fiber, which is euro USD, whatever you're trying to do in your Forex pair, it needs to be in a setup that would be opposing in the dollar. But because the dollar is likely to go higher here, and euro dollar being inversely related to it, it's going to go lower. But it's not randomly just going to some level and starting some mystery as to why it was going to go lower. It's what I'm teaching you. This range, the algorithm refers back to it. So it only needs to go up to equilibrium and slightly higher. So we measure that with the 50 level. Somewhere in that portion of this price leg lower, I'm going to look for a premium array. Well, which ones exist? We have the fair value gap here. So that's the first one. That's your first premium array. Using month 4's lessons on the PD array matrix. So what's the next one? Are all down close candles, back and forth price action. So all of this right here, this is balanced. We've had lots of up and down movement in here. And then we go back to the old high. So we have an order block, which is the last up close candle with the highest close. So it would be the opening price that would be delineated there. Why would it need to go there? It doesn't, because it's shielded by all of this up and down movement. There's no inefficiency. So what PD array do you use? That one. Which did the market use? That one. What time of day did it occur? London kill zone, 2 o'clock in the morning. That's what I teach you. What's the opposing draw on liquidity? Okay, say you got this much right. How do I know where price is going to go to next, Michael? If you're looking at that as liquidity here, okay, and we're at equilibrium or higher, that means we are truly overbought. There's no indicator required to see that. This chart is only showing you ranges being measured, which is what the fib is, and then looking for inefficiencies or liquidity. So at this moment right here, if in fact the market does go higher to take the buy stops here and just trade into a short-term premium, which is relative to this dealing range high and that low, hopefully you guys can see this run from this high down to that low prior to that retracement. This is a significant price swing. Like, I'm not looking at like this little thing here to here. That I'm not concerned about that. I want to focus on intermediate term price runs. Regardless of whatever time frame I'm looking at, my eye goes to specifics in price action. I'm not just taking every little micro price swing. I'm looking at from here to here. Maybe from here to here, but from here to here, absolutely. So it reports on time, on duty at 2 o'clock in the morning. After hitting this, then price is allowed to run. What's it going to reach for? How do I target a run like that? Where does it go to next? Well, if it went up to the buy side here, and it went into inefficiency here, it's in a premium above 50%, and the dollar's looking to go higher, it's in a short-term discount, it's in a fair value gap. You don't need the precision highs and the precision lows. You don't need that. You try to avoid that when you're using higher time frame charts. Try to avoid picking tops and bottoms on higher time frame charts. You absolutely can pick tops and bottoms in the lower time frame charts because they're going to behave subordinate to the higher time frame. What do I mean by that? If we're bullish on weekly and daily charts for dollar, it's real easy to nail down right to the pip short-term lows at key times or kill zones for dollar index intraday. It's just using these types of tools here. But if you're going short here and you're looking for the opposing draw on liquidity, that's this low right there. What's the reason behind that? What would be at that low of any importance, and why would it want to revisit that low? Because it was a sharp rally here. This induces traders to go long. The pattern that they formed here is a pseudo bull flag. Where do fake bull flags occur? In this situation like this. It only goes up enough to validate the buyers on breakout on a bull flag, but it only really goes up to where I teach you. The algorithm sees this area right there. It runs above that short-term high here, and then because it took buy stops into the marketplace, smart money goes short here. So they're selling short here at the buy stops. So two things are being accomplished here. Fair value gap, premium. It trades up into it and takes the buy stops or buy side liquidity right there. So those buy stops, that buy side liquidity has been purged. So if smart money is selling to those buyers, what are they trying to get out at? A discount. Your eye goes right to where retail would be trying to be fortifying or protecting their position. What would be resting below that low? Sell side.